So there's a lot of misconceptions behind technical analysis, and I wanted to give you a better idea of what, first of all, a professional technical analysis setup would look like, and second of all, why some of the technical analysis that you might see online is not very reliable. So this is what a technical analysis chart would generally look like online. There would be some lines drawn, and you would have some stuff, but we'll come back to this later. So before I go into everything, there's two things that I want to establish. First of all, technical analysis has been used and is probably still being used by professionals today. It is something that is used, but it is probably, well, it is much more complex than you can probably imagine. Second thing, the idea behind technical analysis, which is the idea that you can look at how stocks reacted to the past in certain scenarios, that you can find patterns, and that you can then use those patterns to predict similar stocks in similar scenarios today, it is a reasonable idea. In theory, that idea should work, but it is very complex to set up. So, in order to give you an idea of why some of the technical analysis that you see online does not work, I'm going to show you what an ideal technical analysis setup looks like. So if you wanted to set up an ideal technical analysis setup, you would need a few things. So first of all, you would need a database of a bunch of stock charts, pretty much every single stock chart that ever existed, every stock that ever existed. And more importantly, you would also need the reasons why the stock moved however it moved. So if a stock falls, you need a reason behind why it falls, because without the reason, it's not very important. Not having the reasons why a stock moves is equivalent of just trying to predict the weather by looking at just the clouds. If you want to try to predict the weather, you don't just look at the clouds. You look at the climate of the area that you're in. You look at the weather around the area that you're in. Maybe a storm is going to come in. Maybe something's going to happen. You look at the temperature. You look at the humidity. You look at the pressure. There's a lot of different variables that can cause the weather to change. So you don't just look at the stock charts in stocks, you also look at the reasons why they move. And these reasons are very important. They are the majority of the things that we need to know and understand. So after you have these two things, you would need to be able to build a program that could look at chart patterns and link them to specific news that caused the stock to move. So for example, if we go back to this chart over here, if we look at this area right here, we can see that the stock fell a little bit and then it moved up. By just looking at the chart, I have no idea why this happened. I can look at a bunch of other charts and maybe get a better idea, but just looking at the charts, I don't know what's going to happen from this point. I don't know. You can look at similar patterns on other charts, but it's not going to tell you the whole story. You would need to know what company this is. You would need to know what happened. I mean, you would need to know a lot of different news about it. You would need to know the company's business model. You would need to know a lot of different things. Now, if we had a program that could go through that could go through tens of thousands of different stocks and look for similar patterns like this, and then more importantly, analyze the news that actually caused this move to happen. So if we had a program that could look for stuff like this and analyze the reasons why that happened, some stocks it might have been overbuying. By the way, there's this idea that the market is never wrong. The market is constantly wrong. The market is only made up of people, and people are often irrational. So it is very common in the market for people to oversell or to overbuy based on irrationality. So if you're going to have a program like this, you would need to make sure that the program had a lot of different variables, and one of those variables would need to account for the irrationality of people. So if a specific piece of news happens, let's say that the CEO of a company dies, we would need to look at the past and see what happened when CEOs of a company died. Let's say that 70% of the time, whenever a CEO of a company dies that is similar to the company that we're looking at, people overreacted and oversold the stocks. Well, okay, we have a piece of information that we can start from, but we need to look at a bunch of other variables and then determine whether or not the stock right now would give you a decent opportunity of success if you bought it. So if you had a program like this, it would need to look at a lot of different patterns, or not patterns. The program would need to be able to look at a lot of different pieces of news and weigh them properly to each other and relate them to a stock chart. And if you had a program that could do that, then you might be starting to get somewhere. Now, this program would need to be fairly accurate, and it would need to be able to weigh information properly. So there's a lot of reasons why stocks go up and down and stay the same, and usually there's more than one reason. There's a bunch of different reasons you're going to be having to account for: the economy, the risk of a company, the degree to which people act rationally or irrationally to a piece of news. A stock might fall, and it might fall for a completely legitimate reason. Like if a stock falls, the company might just simply be going out of business. Also, the stock might fall because people are overselling it because people think the company might be going out of business when it's not. There's different reasons why companies fall, a lot of the time it's 5% one reason, 10% another reason. If you were going to have a program, it would need to be able to take all of this into account fairly accurately. And also, you would need to be able to find identifiable patterns. So if you had a program that would look at a bunch of stock charts that would look at this pattern right here, and the program determined that this pattern basically meant nothing, and that there was no reliable way of predicting what would happen after this, all this would probably mean is that your program did not account for enough variables. So if you had a program that looked at this specific pattern, for example, and it couldn't determine what was going to happen next, then you're probably missing some variables, because the real world is extremely complex and you cannot predict it with just a few variables. You would need to take many things into account, and people have tried this before. And to set up something like this, by the way, you would need a professional team of programmers. You would need somebody that understood the stock market very well. You would need somebody that understood human psychology very well. You would need somebody that understood reason very well. You would need somebody that understood the economy very well. And you would need to be able to take all that knowledge and program it properly into a program. And only after then might you actually have something that could be called like working technical analysis. And this is extremely more complex than just looking at a chart like a lot of people online do and drawing some trend lines and then figuring out what might happen afterwards based on some patterns that you've seen before. This is extremely more complex, and people have tried this and people have failed, people have succeeded. If people have succeeded doing this, you're probably never going to find out about it because they're going to want to keep it quiet so that they can actually continue making money off of it. But something like this would be very complex. And in addition to this, once you create a program that can actually do something like this, and it can do it to a certain degree of accuracy, the problem with a program like this is that somebody can create a program that basically counters your program. So if you have a program that buys, let's oversimplify this. Let's say that you have a program that buys stocks every time that they go up, 10 cents. Let's say that you're looking at a specific stock. We'll say it's Apple, and you have a program that buys it every time that Apple goes up 10 cents under a specific scenario. Well, I can make a program that will basically be able to predict when your program is going to buy the stock, and I can specifically buy the stock slightly before you do and make money because your program is buying massive amounts of stock. Basically, I can manipulate your program if I understand how it works. So it becomes this game of cat and mouse where you need to be able to constantly update your program and make sure that nobody can manipulate it. Because if you have an automated system buying stocks, somebody can manipulate that, and you need to be very careful about it, because you need to make sure that if somebody understands how it works, they can't manipulate it and make a bunch of money off it. Because if you have a certain way that you buy stocks, somebody can artificially create that scenario and force you into buying a lot of stock, force your program into buying a lot of stocks, and then it would be a very ugly scenario. So it would be extremely complex to do this, and this is it's completely different than what people are doing online today. It is completely different from the technical analysis that you often see online. People took the idea of technical analysis and they oversimplified it. They basically took this premise right here and they got rid of this part. So they got rid of this part completely and they just looked at stock charts and just oversimplified the idea that if you can look at stock charts and find certain patterns, then you can predict what other stock charts will do that have similar patterns. That is way oversimplifying it, and it's not going to work. It would be the equivalent of predicting the weather based on how many clouds there are. It would be extremely inaccurate. Sure, you would succeed sometimes, but you would also need the temperature, the pressure, the climate, whether or not a storm was coming in, stuff like that. You would need much more information. So hopefully that makes sense. Hopefully it clarifies some things. And if this helped, share it with some people. Hopefully we can get the word around and have people understand the difference between, real technical analysis and just some of the stuff that people do online. And yeah, hopefully this was helpful. If it did, leave a like, by the way. Those help.